In this week's video, we'll cover the latest charts, data, and studies, and a major difference between the year 2000 and 2024 that could propel stocks to new highs. We'll cover new developments related to demographics, AI, market leadership, and the tape. Last week's video had a lot of tape reading in it. Logical question, was it helpful this week? What is the tape telling us as of August 16th? In last week's video, we talked about on Monday, August 5th, the Nikkei in Japan basically crashed down 12%. In the United States, the VIX spiked to 65 after the open on Monday, August 5th. And we talked about nailing down some very nice profits, but for the most part, leaving most of our account fully invested, roughly 94%. Because as we covered last week, very early in the session, we started to see things, including interest in technology stocks just minutes into trading on Monday, August 5th, that told us to try to be patient. And around lunchtime in the US, we knew that Europe hadn't crashed. That was good news. And at 2:33 p.m. on August 5th, we noticed that the market had areas of potential support not that far below. And that included anchored volume weighted average price lines tied to these gaps from Q4 of 2023. Then as covered in this tweet at 9:47 a.m. on Tuesday, August 6th, the VIX came back down to a level that told us it's possible all of this volatility is in the rearview mirror, with the key word being possible. And the Treasury market, the actions of market participants, neither were screaming imminent recession. And from a contextual perspective, it's also helpful to know the S&P 500 peaked on July 17th. Our model account was up a little over 20% on July 16th. And we, like the market, experienced a rather significant drawdown. However, the data that we had in hand on multiple time frames told us, for the most part, to stay fully invested. And relative to these profits, the game plan was, let's nail down some of the profits, wait till things settle down, we can always redeploy the cash. And as clients know, we have done that. We began that process last week, and for the most part, completed it this week. And those facts included from last week's video that stocks made a stand near logical levels, or at a minimum, they were close to logical levels, and little damage had been done to the long-term trends thus far. In history, and the charts that we had in hand said it's possible that tech and growth, two areas of the market that had been getting drilled in recent sessions, could resume their leadership. So this is from a week ago. If we fast forward a week, did any of that happen? Right side of your screen is intra-week performance during this session on August 16th. Each of these ETFs and the VIX were taking the closing price on Friday, August 9th, all the way out to the intraday price around 1 p.m. Eastern Time on August 16th. And in terms of the Q&A on was the tape reading from last week helpful, the answer is so far so good. SMH Semiconductors up almost 10% this week. The tech sector up almost 8%. Growth stocks over 5%. SPY, large cap SPY up 4%. Small caps 3%. Mid caps 2.7%. Value stocks 2.55, equal weight S&P 500 up 2.4, and your laggards, defensive staples, inflation hedge-oriented energy XLE, defensive utilities, and the Fed is going to cut rates rapidly and at a significant magnitude friendly, REITs down for the week. So this performance here for IYR aligns with the slow rate cut cycle, and we know that the performance historically in those cases for the stock market was quite good. And thankfully, the VIX between the close on August 9th and intraday on August 16th also pulled back substantially, down almost 28% for the week. Upper left-hand corner of your screen, sentiment when it gets this washed out from Ned Davis Research. Here's the Twitter handle up here. Stock market performance walking forward, excellent, using data going back to 1994. Also noteworthy that Cisco Systems, the poster child for the dot-com bull market and ultimately the dot-com bubble, It rose from these lows in 1990 to this peak here in the year 2000. It's a 9-year window of extraordinary gains. And yes, it gave a lot back. But at the low in October of 2002, the gains from this low in 1990 were still substantial. The message? 9 years is a long time. We have not been talking about AI for 9 years. We've barely been talking about AI for 9 months in the markets. Bank of America research, AI bubble? Nope, we're just getting started. You can pause your video player to read their research on the right side of your screen. And all of this says it's a good time to consider putting new money to work. And we want to emphasize that this new client window is for clients that are ready to go for the most part, or very close to being ready to go, meaning you've been watching these videos for a long time and you're confident you want to be a client and team up with Shavako Capital Management. If you have a special situation, say you're retiring in a year, you can still contact us in this window and we'll add you to a list. And when that retirement date comes around, we will honor that request that was made in this window. You may remember in the August 2nd video, we used these stock versus bond charts. This is basically the S&P 500 relative to a long-term Treasury mutual fund. We noted the vulnerable look here in September of the year 2000, right before the S&P 500 really started to tank. And using this chart dated August 1st, we said this really didn't look anything like this over here on the left side of your screen. Also noteworthy in terms of differences between the two periods, because you'll often hear in 2024 that the tech sector and AI is a bubble, just like the dot-com bubble heading into the year 2000. Well, this chart really doesn't look like this chart, and there's another major difference. In the year 2000, before the S&P 500 really started to tank in September, the Fed raised rates 3 times. February 2nd, a 25 basis point increase, March 21st, a 25 basis point increase, and May 16th, a 50 basis point increase. That is almost the polar opposite to the expectations that we have in mid-August of 2024. The market right now is pricing 100% odds that the Fed is going to cut interest rates in September, 74.5% favoring a 25 basis point cut in September, 25.5% favoring the larger 50 basis point cut. And you can see if we update this chart as of August 15th, we did have an overshoot. That same ratio undercut both the 200-day moving average and the 250-day moving average in black here. As we've noted numerous times, it's not unusual for markets to overshoot. If we were to look at this chart with the moving averages in isolation, the trend in the present day looks a lot stronger than it did late in the year 2000. And as noted in this Bloomberg article dated August 15th, the Fed's getting ready to cut, which is significantly different relative to Fed policy in the year 2000. It's also important to understand the primary reason why the Fed is cutting. It's not because they believe the economy is incredibly weak and they need to cut immediately to avoid a recession. It's because inflation has come down. Think of it this way. If inflation had stayed constant for the past year and interest rates had stayed constant for the past year, then the restrictiveness of Fed policy for the most part would have stayed constant as well. So in the last 2 years, as the inflation rate has been falling and the Fed has been holding rates steady, it's like tightening policy. So now they feel that interest rates are too restrictive given their dual mandate of stable prices and full employment. Now all of this, the 25 basis point cut, the reasoning behind the cut, and the still strong trend on this stock bond chart, all of it aligns with and favors a slow Fed cycle in terms of how rapidly and the magnitude of their cuts. And as we covered last week, there's a stark difference between stock market performance in fast cutting cycles and slow cutting cycles. NASDAQ performance for the slow cutting cycles, lower right hand corner of your screen, looking out 1 month to 2 years. As we noted in last week's video, one of the reasons to go through a painstaking process to build the secular volatility model was that walking forward from 2018, the evidence continued to pile up, favoring a demographically induced secular bull market that could last until 2035. More on that topic via the links below. And more evidence came to light this week that aligns with, rather than contradicting, the secular trend thesis. Headline from the Wall Street Journal dated August 13th, 2024. The dramatic turnaround in millennials' finances. From that article, millennials are now wealthier than previous generations were at their age. Now, frankly, anyone that's been watching these videos for a few years shouldn't be shocked by this headline. Passes a common sense test. And the data for years has told us that for the most part, the millennials doing similar things to previous generations, just a little slower in terms of their adoption. Headline from April 18th, 2024. Millennials are coming for your golf communities. Text on the right side of your screen comes from the top article, again dated August 13th. The secular volatility model leverages the concept that it's powerful to understand what's happening on multiple time frames, and that it can be very, very beneficial to understand what's happening relative to the big picture. We're going to take this monthly chart of the S&P 500, and we are going to walk forward all the way until August of 2024 to see what we can learn about the present day and risk and reward. Lower left-hand corner of your screen is the S&P 500 from 1968 over here to 1982 here. And since the stock market really didn't do much of anything between 1968 and 1982, it was wildly volatile and for the most part went nowhere between point A and point B, it reminds us of a dangerous myth that can creep in during secular bull markets. And that is that the stock market always goes up. History tells us the stock market can go virtually nowhere for years and years and years. But we also know that when the period of secular stagnation ends, the longer a market goes sideways, the bigger the move we can expect to get when the market either breaks out in a bullish manner or breaks down in a bearish manner. And in this case, we broke above the orange box in a convincing manner in 1982 by exceeding this high here. And since markets move in fractals, just like a 60-minute chart or a daily chart or a weekly chart, eventually the market needs to consolidate its gains. It's very common for periods marked by strong trends to be followed by periods of consolidation. And in this case, it's very, very common for a period of secular stagnation on a longer-term time frame to be followed by a secular bullish trend, and eventually you revert back to a period of secular stagnation where once again the market makes very little progress and tends to be very volatile. Now we're getting very close to the what can we learn about 2024. In the upper right-hand corner of your screen, if we go back to the 1982 to 2000 secular bull, it's noteworthy the fractal applies to the secular bull as well. The market needs to consolidate its gains. The market needs to consolidate its gains. The market needs to consolidate its gains, etc. But with this look, we had to respect the fact that this still looks somewhat similar to this turning point here in 2007. Shares some characteristics to this window in here, this window in here, and this window in here. So when we have this look in 2022, upper right-hand corner of your screen, we're not sure, for the most part, what's coming next. It could be something like this, where the period of consolidation is followed by gains. We break out of the blue box, gains, we consolidate, gains, get out of the box, gains. Or if we moved into this area here, we could take on a look like this, 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 or this. So in late 2022, we still have the look of a secular trend, but it's on the ropes. And we were still seeing periods marked by strong trends, followed by consolidation, strong trends, consolidation, and a strong trend. And then when the market started to push higher in 2023, things started to look a lot more like a secular trend again and a lot less vulnerable. So now it appeared we were in another one of these blue consolidation boxes, and we were knocking on the door of the top of the box late in calendar year 2023. And like the 1982 to 2000 window, in the current secular bull, breakouts from boxes, that includes orange boxes, are typically followed by satisfying gains. So where do we stand in the present day? We're well above the blue box here, and the monthly price chart of the S&P 500 is still well above the Bollinger Bands. So if we review it objectively, August of 2024 has started to drift away and really doesn't look really anything like this period in here, this period in here, nor here, nor here. And it looks a lot like this period in here, this period in here, this period in here, this period in here, here, or here, which speaks to the probability of good things happening relative to the probability of bad things happening. And really the moral of the story here is we don't have any evidence in hand, visually or numerically, that says anything other than secular trend. And it doesn't even appear that the current secular trend is on the ropes. This is what on the ropes looks like. So as you might imagine, our investment allocations in a window like this, where the stock market is not really making any progress and it's really not going up, our investment allocations would be significantly different based on the secular volatility model in this window relative to this window and this window. And this orange box lasted from 1968 to 1982. The market can go nowhere for a long period of time. This box, the year 2000, it took until the year 2013 to break above the orange box. And we don't want to get complacent about how bad things can get in the stock market. This drop from this peak in 1968 to the low in 1970, over 36% in the S&P 500. The 1973-74 bear market hits the devastating stage. The market lost over 48% of its value. The more recent devastators, when the dot-com bubble popped, the S&P 500 lost approximately 50% of its value. And during the financial crisis, it was a painful drop, very, very close to 57%. You can imagine what this would do to your net worth and your portfolio balance. Hence, why in these periods here, we respect that at any point, it's possible that we would leave the secular trend window and go into a more painful drawdown. So our strategy is mitigation 1 in these windows, mitigation 2 in these windows, allowing us to get much more defensive and allowing us to significantly change our asset allocation. There are numerous ways to make the argument that in the present day we could be in this window here somewhere, and in this window here into the year 2000, it was a technology-driven bull market. Personal computers, spreadsheets, networks, and most importantly, the internet. That's very, very similar to what we have in the present day with AI. It's worthwhile to listen to this 2-minute and 40-second clip. There's a version of it in our Twitter feed at Shivako Capital. In the clip, he basically says there's 3 things that are happening, and they're going to happen in the next 1 to 2 years that are going to be very, very significant in terms of productivity, helping us keep an open mind about better than expected outcomes, looking out 1 to even 10 years with realistic expectations about normal volatility that can occur within the context of a secular trend, including the 1987 crash. And again, all of this mounting evidence in recent years and the potential for artificial intelligence to significantly boost productivity, and the knowledge that the outcomes during periods of secular stagnation and the outcomes during secular trends can be significantly different and almost polar opposites. Those are some of the reasons why we're willing to work for months at an incredibly tedious task. But working for months could realistically assist us for the rest of our investing lives. And we look at these simple and powerful patterns in the context of the encouraging studies that we covered in last week's video. A week ago, it helped us keep an open mind about tech and growth resuming their leadership. And from a weight of the evidence perspective, Dean from Sentiment Trader handle here, website bottom of your screen over here on the left side, identified an extremely rare signal tied to the technology sector. And that signal was generated on August 14th, and it aligns with the bullet point from last week's video. Been 11 signals that Dean and Sentiment Trader identified going back to 1966. Walking forward, the technology sector was higher a year later, 91% of the time, with gains somewhere in the neighborhood of 20%. The average max gain in all cases was 28.5%. The average max loss, looking out 12 months, under 11%, with very favorable looks looking out 1 week, 1 month, and 2 months as well. In this study, as well as our present-day secular volatility model scores, tell us it's important to keep our focus on the primary goal, the right side of the screen, while respecting that even within the context of a secular trend, we can get significant drawdowns, and maybe even more importantly, always having a game plan to deal with the historical cases that fall into the devastating category. So as we covered in detail using this chart here in July of 2023, over a year ago, the demographic overlays on these charts are powerful. And the millennials are doing just fine, meaning they are not the weak link in the chain. To recap, in January of this year, you can make an argument that we were similar to February 23rd, 1957, and similar to July 31st, 1989. There was a lot of upside left in the secular bull market walking forward from July 31st, 1989 to March 24th of the year 2000, and there was a lot of upside left walking forward from February 23rd, 1957. The additional gain in the S&P 500 into November of 1968 was 149%. As we noted last week, we'll be heading into another phase of this long-term project, and the bullet points on your screen from last week's video, they still apply this week, including that we just opened a new client window, and it will most likely remain open for another 2 to 4 weeks. There's a ton of information available on our website if you go to the upper right-hand corner of the screen on the website and click on Site menu. Everything that happened in the last 5 trading sessions since the August 9th video aligns with, rather than contradicts, the key points on your screen. But we all know the only way that we can use all of this effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.